Start with what Rakesh said is one of the prime reasons why he is bullish on India, why he is bullish on Indian macros, the commodity super cycle. I mean, I'm beginning with that question because all of you are heading foreign brokerages and in a sense are on the cusp or are on the borders of the foreign view of India, which is why I want you to delineate the global scenario for us and whether that will remain as clement to India and to Indian equities as it has been over the last 13 months. Okay, to start with you, Ridham, would you say that this commodity super cycle, which is at its perhaps lowest ebb compared to the last maybe 10 years, will continue that way for, say, another 12 to 18 months?
Which actually doesn't need to. See, if you go back to 2003, net commodity imports for India, ex-gold, so exclude gold, was 1.5% of GDP. That number by 2012 was over 7%. So for the bull run in commodities, which was led largely by China, we paid 550 basis points of GDP. That's the cost on our current account. That's what it cost us to inflation. And it cost us about 125 basis points to growth. Okay, even while we averaged 7% GDP growth. So without the commodity bull run, we would have averaged over 8%. Okay, now that number has already come down to 4.5. At current commodity prices, it will be at 3.5 in the next 12 months. So even if commodity prices don't go down, I've got a give back of 350 basis points. That's going to drive up growth by about 75 bips. It's going to bring down inflation by 350 bips, which is why when Rakeshji was talking about it, I said I completely agree with him. And we're not seeing that full picture right now. It will bring down our CAD by the same number. This is a disruptive positive change for India. It's disruptive. Forget about what the government is doing. Forget about the growth cycle. This is such a big change on its own.
But
and I don't think it's fully priced.
You at least expect it to plateau here for the next 12 months.
Latha, even if it went up a bit, okay, I'll get 300 basis points. It's still a very big change. Now the likelihood is that it may not, because there is no, I think there was a question here about global growth. So I'm actually happy to see global growth where it is. I don't want the world to come back. Commodity prices will go down. It is good for India. It's godsend.
Well, absolutely.
So I don't think you have to worry about global growth. We have to worry about China coming back. But it's difficult, I think. China has built up so much of leverage. It has to unwind its debt. It's unlikely that we're going to see that type of demand on commodities that we saw. In fact, India will be one of the biggest consumers of commodities in the next 10 years. But it's unlikely that commodities go up like the way they went up in the last 10 years.
Would you agree, Abhay, that we are going to see inflation dip anyways because of this huge global commodity super cycle at its lowest ebb? Do you think, would you agree, therefore, that Rajan could have been more lavish with his rate cut? First, your view on commodities. Would you agree that we are going to have another very benign year of positive commodities? That is bearish for us.
That's right. No, we do believe that. Completely agree with that, and completely agree with Ridham that that itself seeds India's virtuous cycle. Remember, India's vicious cycle had started with the commodity up cycle. And particularly in the last 2 to 3 years, it was really the high commodity prices which ultimately translated into all our problems, leading to the fiscal deficit and higher inflation. So completely concur that the sedate commodity cycle is going to be very positive for India.
Okay. Neelkanth, what's your view therefore on, so many of views expressed on the credit policy? Rakesh believing that, Raghuram Rajan will perhaps in future believe that December itself he could have cut rates. What's your own sense? That was it wise to have waited? And more important than that, is it really going to change the foreign view, the big investor view on India itself? Or will that view be strengthened that, the rates are being held where they should be?
Well, I think this rate cut, whenever it happens, is not any other rate cut. I mean, it will be an inflection point, which is something that the governor mentioned in the policy document as well. You cannot take that lightly. So you cannot cut a rate and 3 months later say, oh, sorry, I was wrong. I'm going to maintain rates or raise rates again. So I think it's much better to be prudent. See what had happened from July to November. I think very few of us do our vegetable shopping ourselves. But if you do that, like I do, there was a very sharp spike in vegetable prices. Tomatoes went from 15 rupees a kilo to 80 rupees a kilo from July to November. And there was, in India, there is a very high concentration of vegetable production. So if you have weather disruptions in one area, the big disruption. So all of those reasons led to a big spike from July to November. From about first week of December, we saw a very sharp decline in vegetable prices as supply came into the market. This year, if we don't see that, we will see CPI going back to 7%. Right? So it is important that the governor and the RBI wait 2 months and see if we are going to see a repeat of that before they embark on a rate cut cycle. So he signaled very clearly that he is comfortable. I mean, he is also very comfortable with the price of oil coming down. But I think it is much better to be prudent.
You study these animal farm prices, as you called it, your animal farm series, where you've looked at milk, meat, eggs, vegetable prices very closely. Do you think the back of inflation has been broken? I mean, this time, despite a bad monsoon, we did not see 12 and 13% cereal inflation. Last year, with a record monsoon and a record kharif, we saw 12 and 13%. So is the back of inflation broken?
Some of our anchors that we're using for the economy, I think, are wrong. And I don't think commodity prices and global commodity prices are I think it will be good for us as we are growing in the next 10 years to have low commodity prices. But I don't think they matter that much. I think what matters is that half the households in India who cook on firewood should work with gas or with electricity. The 40% of households that don't have drinking water should get drinking water. So they save 3 to 4 hours a day. That's a massive jump in productivity. We are like a sub-Saharan African economy with a developed world political system. And I think those are the things to be excited about, that state governments are delivering change. I think commodity prices, we need to be very cautious.
That's a 15-year story, of course.
Yeah, but we need to be very cautious on how we interpret commodity prices. There are 3 implications of commodity price. The balance of payment, we only look at the current account. We don't look at capital flows. Where was capital coming from? The capital was coming from oil exporters. If Norway doesn't have surpluses, if Kuwait doesn't have surpluses, if Abu Dhabi and Saudi Arabia don't have surpluses, where is the capital going to come from?
China, it's got a huge sovereign wealth fund.
Right. So I think, and in China, when they want to invest, they will invest with a lot of control. And if you don't give them that control, you don't tell them that, okay, they come and say, give us this road, and you say, no, you come and bid for it, they won't take that road, right? So their ways of operation are very different. So I think we need to be, so on the balance of payment side, I don't think the weak commodity prices are going to be that great. On the CPI side, just 2% of our CPI is petrol and diesel. Right? Yes, and even that is not coming down with the government, I think, very prudently hiking excise duties on that. The second order transmission is being prevented by or slowed down by the fact that after 4 years, you are seeing a recovery in the transport cycle. Right? So for 3 years, the freight operators were absorbing diesel price hikes. For the last 10 months, they've been seeing a hike in freight rates. They're not going to pass on everything. So yes, there will be a tapering because prices are not going up anymore. So over a period of time, you will see a slight slowdown. But I don't think it's going to be as big as it's being made out to be.
So the 4% inflation, which appears to be given for Ridham and Rakesh, is not a given for you.
It's too early for me to take a call on that. I would wait and see how vegetable prices move, because milk prices are still high. Right? Milk powder prices globally have come down.
Yes.
So some companies will tell you that, great, milk prices are coming down, but milk prices and CPI, milk prices year on year in the stuff that you buy, I don't think they're coming down. So we need to wait for another 2-3 months and see if the back of the food inflation has been broken. Most of it came from animal products and fruits and vegetables. And then we can take a call on whether 6% is right for the next year.
Okay. Ratnesh, does it really matter? I mean, for foreign investors investing in India, is the rate cut such a big signal?
No, as Neelkanth mentioned, that because this is going to be a turning point, so to speak, in terms of the trend and the policy stance, to that extent it is important. But if you are looking at the market, equity is a long-term asset class, whether it happens in December, whether it happens in February, or whether it happens in April, I think the direction is clear. And to that extent, maybe Governor Rajan has succeeded in one thing, is got everybody talking a lot more about inflation than they ever did. So probably that is what objective successfully done. But I think from the equity point of view, what I look at is from interest rate point of view is the important thing in India is when do you get the whole investment cycle going.
Exactly.
And will the interest rate cut of 25-50 basis points today or in February and April, is that going to have a meaningful implication for when the investment cycle is turning? Probably not on the longer term horizon. Because ultimately you make best amount of returns from equity when for least amount of investment you get maximum amount of profit, which is in economics terms I call incremental capital output ratio. So that is what I'm focused on. You have a whole lot of capital which is already invested in India, earning zero or negative returns today. When that begins to produce return through, removing some of the problems which might be there in terms of bottlenecks or regulatory problems, etc., the kind of fillip that it can give to growth and productivity. And similarly, on the other aspects of inflation which we talk about, I think India is all about efficiency gains. Even inflation, the way I look at it, it is a story about efficiency gains. If we have efficiency gains, inflation problem is taken care of. If we don't have efficiency gains, then we are victim of commodity cycles. So by efficiency gains, I mean, investments, whatever that need to happen in terms of supply chain, or like this time you saw from the government, very proactive actions to take care of certain vegetable prices, etc. So those things are what I call efficiency gains. To my mind, in the longer term, they will play a far greater role in controlling inflation or managing inflationary expectations than some of the near-term volatility.
Okay. I want to ask about the inflection in growth. When are you all expecting from all of you? When is that turn in the quarter coming? That 2003 fourth quarter that we saw, when you saw the sudden change and, thereafter it became a virtuous cycle. When is that? Every time when the GDP numbers or the second quarter or the third quarter earnings are around the corner, you hope this is the one. When is that quarter?
So Latha, in 2003, the recovery was like this.
Yes.
It was V-shaped. Right now it's U-shaped. And it's already happened. The bottom is behind us. It was December 13. Broad market earnings growth was -5%. Today it's in the teens.
Okay.
So we are already actually on our way. I think in the next 4 to 6 quarters, we'll probably hit 20% earnings growth. And I think, so my estimates for F17 on the Sensex are 20% ahead of the street, and I think there's upward risk to my earnings estimates because we have not fully factored in the decline in commodity prices. So I think the street models this on an Excel spreadsheet, but in reality earnings don't work off Excel spreadsheets.
Okay.
So I think we will get the earnings cycle that you're looking for. I think it's underway. In the next 3-4 quarters, it will start getting visible, and in the next 5-6 quarters, I think we should hit the 20% mark.
I can't calculate so fast. So why don't you tell me what is the Sensex earnings FY16, FY17?
So the street is at 1600 rupees EPS today for F15. Okay. Take it forward. My number for F17 is 2500 rupees. Okay. Approximately. I mean, it's a little bit more than that, but that's where we are approximately.
Okay. And you think that is the underestimation?
I think there's upside risk. I mean, it doesn't assume any major policy reform from the government. It doesn't assume a major rate cycle. It doesn't assume oil even at $65. It assumes oil at $90. Okay, so just to keep it into context.
Better than the base case.
Yeah, so I think there is risk to the upside here, both on equities as well as on earnings, which probably plays out. And of course there are risks. I mean, it's not without risk. We have to worry about the world in the near term. I don't think the world is a settled thing. I would worry about geopolitical risk. I would worry about interest rates in the US in 12 months from now. I would be very worried about China. I think China could be disruptive.
In the sense if it stopped degrowing or stopped contracting and stopped slowing and picked up speed.
Yeah, the biggest risk is it exports deflation to the rest of the world, which then triggers policy.
So you're worried about a Chinese slowdown rather than a Chinese pickup?
Well, I am actually worried about Chinese currency moving in order to promote Chinese exports and therefore export deflation to the world. So those are risk factors that could play out in the next 12-18 months. But I think big picture, I think India is on its recovery path for growth, and it looks like we should do quite well in the next 4 to 6 quarters.
1600 FY16, 2500 FY17.
F15 is 1600.
Okay.
Yeah, this current
F15 and F16 is 2500.
F17.
2 years.
Yeah.
Okay. Abhay, how does that square with your calculations?
Very similar. We are expecting a similar 16% earnings growth this year and 16% earnings growth next year. So very, very similar. In fact, our expectation is that growth really starts to pick up probably from the second half of the next fiscal year. And perhaps this is going to be driven more from the reorientation of government capex towards investment from consumption. Our view also is that the private sector is probably not going to be as quick to return to invest as everyone seems to be thinking. And therefore the onus of investments will have to be taken by the government. And we expect to see that reorientation in this budget, where the government is consciously shifting from its consumption, from the previous government's bias towards consumption, towards allocating higher towards investments. And here, I guess, we have to see faster progress on the corridors. We have to see faster progress on many of the infrastructure projects.
Ratnesh, would you agree with these kind of valuations? And if this is the kind of earnings growth, and if yours squares with these, would India be expensive at all at current levels?
The way I look at earnings forecast is that, in any case, market leads the earnings forecast by 6 to 9 months. So in the event that whatever is the EPS which comes 6-9 months before, market would try to discount that ahead of time. Other thing which I look at, our own history. When you have an inflection point in the economy, there is operating leverage at work. And historically we've seen that the actual earnings have substantially positively surprised whatever the estimate which might be there. So I'm expecting operating leverage to start working through. As my expectation is that the growth recovery on a top line basis will be better than what the current average forecasts are, and as a result the operating leverage benefit will be stronger than what the forecast. I mean, which bull market have we had in India where we haven't had a couple of years of 25 to 30% earnings growth? I mean, if you think about any bull market, so you know, those sort of numbers are currently not in forecast, because there is a big chunk of the market where the assumptions, and maybe rightly so today, are extremely pessimistic, where, you know, whether you take banks or infrastructure and those kind of sectors. So I am currently at this point in time, my stand is that you know, let us not have too much of, I mean, I think if we have linear thinking at this point, which is should it be 10%, should it be 15%, we will all be wrong. I think we are at an inflection point. When the turn comes, we will be, you know, market earnings, there will be a year or two where growth will be in excess of 25%.
Okay.
That's my view, which is obviously, you know, currently not in any forecast or models.
So it's still in buy mode. I mean, you wouldn't think India is expensive if you're expecting that kind of an inflection in earnings growth.
No, I mean, in valuations basis, if you look at even current forecasts which are there, I think you're probably one standard
17
deviation.
at least, right?
You are barely one standard deviation above the mean. And in my view, the current 1 year, 2 year forward forecasts which are there, if everything goes right, what is happening, all the other things which are being talked about in terms of 4% inflation or you know, whatever else, I think earnings will surprise on the upside.
No, but your analysis is not predicated on a 4% inflation.
No, it's not. I mean,
okay, that would be the icing on the cake.
Yeah, so
2500 EPS, the market is trading at 11 times F17.
2500, yes.
2 years forward, 11 times. Okay. 11 times. Okay. For an economy that will grow 12% top line for the next 10-12 years without trouble, and you know, forget 18%, which Rakesh ji was talking about, 15% earnings growth le lo. Okay. So what is the problem at 11 times for 15% earnings growth 2 year forward?
And the biggest delta,
I don't think valuation is a problem. Okay. And we are not even taking interest rate cuts into account. Okay. So bond yield was 8.1%, now it's 7.95. Okay. So, and in Morgan Stanley's top 15 global trades for 2015, there are 2 Indian trades there, and it's not equities. It's the local bond and the currency.
And what is the call on the currency there?
Well, against the euro, not dollar.
Okay.
So we're expecting that to go from 77 to 69 against INR euro cross. And the bond yield, when we published the report, it was 8.1 and we said 7.5.
Okay.
Congratulations. Two top trades in 15. I've not seen that happen before in my life. We had a bull market even before, but we have never seen two non-equity trades in the top 15 Morgan Stanley.
When is this 69 to the euro?
This is next year's forecast.
Okay, so those of you going to Europe, please postpone your trip to next year.
And you see, I think related to that point is that, let's say, we quibble a lot about, say, what should be the EPS or earnings growth, whether it should be 10, 15, 20. But the biggest delta for the market comes from risk premium.
Okay.
Adjustment of risk premium, which reflects in your bond yields, which is obviously derived by growth expectations and inflation expectation, etc. So I think we have a lot more ways to travel in terms of contraction and risk premium being attached, for India. And as the growth recovery comes back, as the rates, cut cycle begins, I think you will see the risk premiums further contract, and that will cause more upside to the valuations.
Okay, well, since all of you are so comfortable with valuations, yes, since I haven't come to you, Neelkanth, also, are you comfortable with these valuations? But more importantly, how long will India be the cleanest shirt in the global laundry? We've had this 35% rise in Sensex and Nifty and this $30 billion come also because others have done a damn bad job of their own economies or their polities. Do we continue to be the best shirt in 2015 as well?
It's a game that we'll have to strive hard to lose. See, I'll repeat that when we compare ourselves to other emerging markets, I think we are fooling ourselves. Mexico was at India's current level of prosperity in 1976.
Okay.
Brazil was at India's current level of prosperity in 83. Turkey in 83. South Africa in 92. Right? We are not comparing ourselves to the right benchmark. We should compare ourselves to Nigeria. We should compare ourselves to Borneo. I think, so from a growth perspective, we will continue to grow. I am not as constructive on earnings, because I think that 56%, the market is not a true representation of our economy. 56% of Nifty revenues are in dollars.
56%
of Nifty revenues are in dollars, which means that they are linked to what is happening
US economy
globally,
or elsewhere.
And of the remaining 44%, which remains, which is in rupees, a lot comes from banks who have lent money to these companies.
Okay.
So if you see a steel company blowing up, you will see that effect in the bank's earnings, right? So I'm not as constructive on a 20% earnings growth anytime in the next 2-3 years. But I do think that the PE multiples will support us. See, right now...
Why so?
Almost 2/3 of the world economy has 0% interest rate. And more than 45% is actively printing money.
Yes.
In the last 5 months, China has printed $250 billion, which at the peak of the US Fed QE was 3 months of QE. Okay. Right? And China is after 60% of the nominal US economy. Japan is doing QE. The Europeans are going to do QE. Economies that were considered to be bankrupt 3 years back have bond yields, 10-year bond yields at 300-year lows, right, or 200-year lows. So I think the world is desperate for growth. India provides that growth. I am far more constructive on the PE multiples holding up or even marginally going up from here. In order to deliver maybe a 20-25% return, maybe a 30% return over the next 2 years. All of that coming from 10-12% earnings growth, which is what we've been delivering, and a marginal expansion in the PE multiple.
Since you spoke about 2,500 as your F17 earnings, what's your Sensex target for F17 and work backwards?
No. Our published forecast is for December 15, which is 32,500.
But that's modest, isn't it?
Yeah.
Going by the kind of earnings growth you have.
It has to be seen in the context of what we expect global equity returns to be. So it's not in vacuum, right? Okay. So it's going to be quite much more than what we think the SPX is going up or what the Euro index or probably in line with what the topics will do. But it has to be seen in that context.
But you would bet that another 15% growth in F16 also cannot be doubted?
No, I think that can happen. Our bull case is a much bigger return.
Which is?
And I'm attaching a 40% probability to the bull case. So then we are talking 40,000 index and we're talking...
Which index?
Sensex. No, for 1 year you're asking, right?
Okay.
On the 10-year view, we've got a far more optimistic.
Please.
No,
we
but
are
that
speaking about longer terms as well.
Yeah, but that was a report we published in early May, so it's outdated now.
So, but let us know the old figures. So
6 months has made a report outdated because so much has changed since then. Oil was $100 then, today it's 65.
No, it was more than 100, I agree.
Exactly.
But, okay, what would you ride on? Would you touch some of the infra stocks which are stuck? Would you, touch public sector banks which are saddled with these kinds of loans?
See, thematically, I think you want to buy 3 sectors in India. You want to buy financial services, consumption, okay, and then a bit of the new stuff that's going to happen, which will come out, which will come out of reforms like GST. So GST will have a meaningful impact on, say, logistics. Okay, or digital may have a big impact on logistics. Okay, so the front end is not available to buy.
If I were to ask you the same question I asked Rakesh, what is the the new theme of from now to the next 5-6 years? Would you say it could be logistics because GST could make it?
My answer is the same as his. I don't have a clue.
Okay.
No, but I think you want to buy good quality banks, good quality consumption companies. Those are reliable places where you can put long-term money to work. I think those should work out quite well. But again, as Neelkanth mentioned, as Rakesh mentioned, this is a bottom-up company-specific thing. When you ask sectors, that's okay for institutional investors. For retail investors, about selecting the right stocks, or otherwise just do.
Depending on you to tell them.
No, but otherwise just do SIP best.
Okay.
Yeah, don't worry about it. Every month, put 25-30% of your savings.
Okay, let me put it
equity.
this way. You expect the Sensex in 1 year to be 32,000. Yeah. What do you expect the mid-cap index to be?
I don't have a forecast for mid-caps, but I think the mid-cap will do much better.
Much better?
Yeah.
Okay, there's that. Yeah. Abhay, same question.
Right. So we are most positive on financials and consumer discretionaries. We actually believe that we are going to see a transformational shift in the financials, for financials, particularly the big transition that will happen from physical to financial savings, and that the conduit of that will be through the banks.
Financials is only private sector, like most of you think?
No, we believe that the time has come to take the risks on public sector banks. Okay. And this is something that we have been highlighting. We think that the risk reward is far more compelling today for the public sector banks. So yes, we like the private sector banks, but in terms of the risk reward, it's beginning to look extremely compelling. So far, this has been one sector that has been shunned, but we think that that's exactly the reason why investors must look at it. Okay. So here, of course, we are going to be very selective in public sector banks. I'm not saying buy the whole space, but selective public sector banks, I think that's the best trade for 2015.
And the other two sectors, you said financials is
consumer discretionary, okay. And agree with Ridham that the next drivers will emanate from the reforms, particularly the beneficiaries of the GST. So I think logistics, that's going to be one sector that's going to look very attractive. Unfortunately, valuations are beginning to run over there.
Name names?
No names.
Okay.
I'm held back by my compliance.
Yes, I know. The rules have gotten a tad stricter. Ratnesh, same question. What kind of targets are you, have you, given for end of year Sensex and Nifty for 2015?
So the convenient answer is there is no one-year target that I have which is given out. But if I look at equities per se, whether it's for retail investor or institutional, I think you have to have at least a 2-3 year view. And if I'm looking at next 2-3 years, I'm expecting to have 20% type of a CAGR from the market or portfolio stock, whichever way you look at it.
20% CAGR?
Yes, which will be at least about 15% of earnings growth average, and about balance is a further re-rating, which I expect. So which is a fairly healthy sort of a return. I mean, it may not be even 20% type of a return, but I think next 2 to 3 years, all the factors are aligned to see that kind of a return from the broader market, within which obviously there would be greater upside from some segments.
Okay, and would you also believe that the mid-cap bet would bring more moolah?
It always has, in both on the way up and on the way down. So they have a higher beta, which is natural. So obviously, if my expectation is that broader market gives you 20%, then mid-cap index will give better.
As Shireen was asking, is there an interval sometime in 2015, post-budget, or after the first quarter earnings, when that inflection doesn't come in the first quarter, or sorry, the last quarter of FY15? Is there an interval possible?
We think that there will be an interval probably when the fourth quarter earnings are being announced, because our view is
April,
that
May.
It could be March, it could be April. The reason being that between now and February, you've got some very compelling macro catalysts, particularly in the form of the rate cut, a likely sovereign rating upgrade for India, which we believe will enter the narrative, enter the discourse probably sometime in Jan and Feb, and probably in the aftermath of the budget if we see a very credible fiscal arithmetic. So we think that these drivers are very compelling today, as a result of which the market is willing to look beyond the macro, willing to look beyond the earnings. But if the market has run up, which we believe it will, between now and February, and if the earnings season and the macroeconomy is not seen stabilizing when the fourth quarter numbers are coming out, then there could be a period of indigestion, and that might be the time when India sees its first real correction in 12 months.
Your take, Neelkanth.
I think the lead will come from the global markets. We are right now celebrating the fall in oil. The kind of stresses it creates in economies like Russia, Venezuela, even Brazil, Australia, I think those aren't fully appreciated. So far, the first order effects are more or less priced in, meaning those particular markets have corrected, some particular stocks have corrected, but the interlinkages are not really clear yet. There is some leverage in the system globally, and that can cause disorderly correction in the market. So far, the market is just yawning about these things, because every time it corrects, some central bank throws money at it. But I think that will stop working after a while, and so that is when we see.
So that could happen as early as
next 3 months,
first half of 2015. Okay. Well, let me end where where my heart really is. What is the 10-year, 12 months down the line?
The 10-year bond.
Yes.
No, we don't have.
Yield.
Yeah, I said 7.5.
I mean, is it 7? Is it 675?
So our official forecast is 7.5.
Okay, not much then. Another 50 basis.
Yeah.
Neelkanth?
Yeah, the official forecast is effectively there as well. I would think that more like 7 would be.
More like 7. Okay, that's saying a lot. Ratnesh?
Yeah, so I don't exactly remember what my economist's exact forecast is for the bond deal, but fair enough to say that I think whatever, again, the rate scenario that you're looking at, we have to look at it not on a 6-month or 12-month basis. Once this rate cut cycle starts, chances are it will continue for more than that. So what we should be looking at is a couple of year period where existing rate expectations will be, the actual action will be even better than that, in my view.
Okay, better than 7, you mean? It could be even 675. Is that what you're saying?
I don't have a number, but I'm saying whatever is the consensus which you have, the reality will be better than that.
It could overshoot.
Yes.
Abhay?
It's going to overshoot. Because we are moving, as I said, from the...
Anybody for 4% inflation and therefore 5% on the 10-year?
In a year, you asked.
You tell me. Yeah, I'm asking you. I was asking them for 2015, but...
Because Greece is borrowing at 4%. So, India borrowing at 5% is not something out of the world.
No, but do you see that happening in a couple of years?
Yeah, it should be. I know it is going to happen when, I don't know.
I mean,
So you called inflation at 4% in 1 year. So you should, I'm only asking you, when will the yields go at 5%? The yields go according to inflation expectations. They don't go wherever the governor goes. Governor will sit at 8. Yields are already below 8 for 10 years. They are not following the governor.
Yeah,
They had gone. They had gone in 2003.
2003.
I have a point here, which, if I'm permitted.
Yes, please. Actually, the house is open for questions.
Well, there is a parallel here we cannot miss, which is Brazil. And before that, there's another. Okay, in Brazil, when the last bull run happened, people made more money on the debt markets than they made on the equity markets. So if 100% of people here are bullish on equity, chances are more money will be made on debt than will be made on equity at one level, which means in Brazil, the currency went from 3.4 to 1.7 over a 4-year period. which means leveraged investors actually doubled their money only on currency, and the interest rates went from 16 or 18% down to 12%. The only thing that happened was the government let go of the embargo in terms of how much foreign capital can come in. And chances are that the Indian banks aren't able to lend because of Basel III and their inadequacy of capital which is available today. The only option left will be for more foreign capital to come in, which means the chances of this becoming 5.5 at the end of the year is more likely, because the currency may not be allowed to go completely, gangbusters. So you may make much more money on the debt market. So if there's an empirical evidence that you can draw from, it is Brazil.
That is actually as much a headline.
The problem is not this in Japan. The yen went from 400 to 76, and the interest rate went from 8 to 1%, and you could buy $10 billion worth of bonds if you wanted.
No,
that was the size of the market.
The only reason I didn't take Japan was because there were no capital controls in terms of JGB holdings, whereas in Brazil there was, and they actually had to. So actually we have an example of 8 years ago, which actually is waiting to replicate itself, because nobody is talking about the extent of gains you can make in the debt market with just a 1%.
No, the short advice is to investors, as much as you invest in equity funds, don't forget the debt funds.
No,
the gilt funds.
Just to support the point that Jakes is making, top 15 trades globally, we have only 2 emerging market trades. And both are on India. One is on Indian debt and the other one is on the Indian currency. I don't have Indian equities in the top 15 trades. So what he's saying is exactly what we are saying for 2006.
But Latha, leveraging is not possible. That's the problem.
Sorry?
Leveraging is not possible. How do I buy a 30-year with leverage? Tell me.
Yeah, leveraging is not.
There's no leverage available.
Maybe it will come. We are on the cusp of a.
Yield will be 5% when it will come.
And Latha, related.
Ask the governor to do that.
We are on the cusp of perhaps a bond market being born. Then you will be able to leverage there as well.
Latha, just one.
I have to hand over the mic actually to Anuj, because for questions from the house, Anuj is here to conduct. Go ahead, Anuj.
So, Jake, let me complete.
Anuj, mic.
Okay, so lots of wisdom here from the sell side. I'll come to the buy side to see if they're convinced or not. But first, let Jake complete the point.
Just one other point. We've been making too much about RBI governor. At the end of the day, RBI is a regulator and a policy maker, but the owner of banks is the government. So we don't need Mr. Arun Jaitley to go and ask for interest rate cuts. As the owner of banks, he can pretty much make these rate cuts happen. Today, the RBI was bemoaning the fact that we can't tell the banks to cut rates. Who can? The person who can should be doing it. So rate cuts can happen on their own. They don't need the RBI supervision for that.
All right, so let's go to buy side. We got Madhu Kela here. Madhu, convinced by the 4 arguments, and would you be putting incremental money to the markets now?
I don't think I needed them to convince me. So we've been fairly bullish, and we've been bullish when the cloud was far more darker than what it is today. But I'm definitely convinced with Jake's argument that over the next 2 years, there's a lot of money to be made in fixed income. There is no doubt about that.
Okay. We got Andrew here. Andrew, on the panel, we had thought that it's time to bet on PSU banks. I know you have a slightly different view on that. Would you want to share that?
No, I mean, it's not a different view in the long term, but in the short term, we still think there's a lot of problems with the PSU banks. So when markets rise, we like to kind of rent them rather than own them. I don't want to own PSU banks at the moment. But one question I do have for the panel, and you touched on it, I don't know who it was actually, was the risk for China, because I think that's where I tend to worry in the very, very short term, is what can China do which will damage the world economy and global investment sentiment?
Ridham, what can China do that can damage the world economy?
China is sitting on so much of debt, and they are dealing with deflation. It's a threatening combination. India actually has the opposite of the whole world. India does not have much debt, a little bit in the private. It doesn't have deflation, and it has demographics.
Its way out of debt.
It has demographics. Europe, Japan, China have the opposite problems. So it's a bit threatening. I mean, they could depreciate their currency to export that deflation. There is a lot of capacity sitting there which needs to be utilized. I don't know if you guys have gone to aliexpress.com. Do that. You'll realize what you can do, what China can do to...
I know one guy who has. He's sitting here in our audience.
You will see what...
Xiaomi Mi 4 from aliexpress.com.
Sorry? Alibaba's e-com site, you can shop there and you can buy stuff for almost nothing. And they deliver it free to India from China, no delivery cost. Well, now the delivery periods are shortening also. So they see that there's demand from India, so they'll probably deliver in 10 days very soon. But yeah, I think that's the risk. It has to be a pertinent risk for the next 12 to 24 months.
Okay, let's get some of our retail investors because, especially the ones who've won the invites here. Any questions? On the back.
My question is to Ridham basically. You are saying the foreign good prices is a boom for India. But the last time when the prices failed, Russia went bankrupt in 97 and 98. So, and the same thing can happen again in terms of Venezuela, Australia and Russia. So, how can we say positively that this is the boom for India?
Okay, that's the question, yeah.
Yeah, the relationship that India has with oil is not linear. It's not inversely linear, it's concave.
So his point is that if they crash so much, won't there be global accidents?
Yeah, that's what I'm explaining. So the relationship is concave, which is up to a certain point it benefits India, and then if there is a crisis in the world, India actually loses out. With the point that Neelkanth made, which is that it starts affecting risk capital flows then. I don't think we've reached that point. But if oil has that tendency, it could crash further, and then it could lead to a bit of a problem for India. So it's not a given, but that is in the short run. So you would get a correction in the Nifty, and things will get a little bit messy, and then it's an opportunity to buy, in my view. However, if you look at it from a 3 to 5 year perspective, if the commodity super cycle has ended, which it seems it has, I think it's hugely beneficial to India. Because then the short-term risk capital flows are not that important. They will even out. But the benefit that the country gets out of lower cost of oil, lower cost of fuel. And mind you, you're only looking oil here. Coal has gone from 120 to 60. Coal falls another $10. A lot of those power plants which became unviable will start becoming viable. The government will have to do nothing. On their own, they'll start becoming viable.
But does it get that bad?
Coal is already at $60.
No, that's No. Is it bad if you're bullish on coal in that sense? I mean, does it fall to 50?
Yeah, but Germany last weekend, Angela Merkel is moving a law change in Germany to ban the use of coal.
Okay.
America has already stopped using coal. The demand for coal in the world is falling. So how do the prices go up secularly? There will be trading up and down, but where is the secular demand for fossil fuels in the world now? Because people are moving towards renewables. In fact, I saw a newspaper story that some fund has sold all its positions in fossil fuels and is moving money into renewables. So I think this is a major move in the Western world to address climate change. So I don't think it is possible that the
commodity dividend is going to be with us for some time.
It's likely, it's highly likely, and therefore it's quite beneficial to India in the 3 to 5 year time frame.
See, one thing which we haven't talked about, but I think is very significant, is this new FPI regime which has come. Just 30 seconds on that. Probably after the FII regime got started in 91, 92, whenever it got started, after 20 years, this is probably the single biggest reform opening up which has happened, where not much has happened, but if you're looking at the next 1 to 3 years, whereby India is now open, both on the debt and the equity. We're talking about debt. Actually, you had more FII flows in debt this year than equity.
Yes.
The entire focus is on equity. FPI, under the FPI regime, the investor class which can come into India and all this debt and equity is broadened from institutions to corporates, trusts, family offices, Mr. So-and-so from Chicago. So that has not yet played out. That will play out if you have a longer term, 2, 3, 4, 5 year kind of horizon. And eventually that will get traction.
Anuj? Okay. All right. I believe that both Anuj and I have run out of time, and as have our guests. Please.
What is this listed of corporate securities? You have done something where you can trade it outside India in the permitted class.
Depository receipt notes. I have a mic. you can write depository receipt notes, and these don't necessarily have to be originated. No, so if there is foreign investor interest, let's say in an Indian equity stock, they don't want to come through the liberalized FPI route. Liberalized is, you know, the panelists are putting it out. But even then, the FPI route comes with a certain burden of regulation, you know, or the ODI route, which has now been equalized with FPI in terms of regulation. Then foreign depositories can in fact initiate depository receipt programs that foreign investors can invest in using the underlying security in India, which could be equity or debt, including government bonds, without the issuer of that security being involved at all. So that's, so it's very big, and it will open up, you know, substantially a huge category of investors. Yeah, it will. And with much less hassles. Much less hassles, but it's still in its nascent stage. It becomes effective December 15th, but it's allowing, so they've allowed listed and unlisted companies to do this, and the security, underlying security can be debt, equity, mutual fund units. It's a huge liberalization in depository receipt now. Okay. Well, on that very positive note, that a flood of even bigger investments can rush into this country, we will ring the curtains on this segment. Thank you, Ridham, Ratnesh, Abhay, for giving us those tall targets, and thank you, Neelkanth, for reminding us that interval jaldi bhi aa sakta hai. Thank you.